Hello and welcome. You're watching KYC, which is Know Your Company, and today we're going to focus in on a software company, Newgen Software Technologies. The stock has been a 16-bagger or 15-plus bagger since the day of listing in 2018. But of late has come under pressure due to its Q3 numbers. We'll try and delve deeper into everything that's transpiring. First off, with regard to the company, and let's stick to the basics first. It's a global provider of software product development, and it drives digital transformation through a platform. It also provides services around Gen AI as well as cloud, and it got listed in February of 2018. Just to try to understand this slightly better, I'm going to try to help that. One was incorporated in 1992. It's a application development platform company. A large chunk of its revenues, so around 54%, is annuity, 60% as of FY24, and 45% is largely software as well as implementations. You will have sale of products as well as sale of services, which will comprise the balance in terms of the revenue mix. The worry here has been with regard to growth in the annuity business, whether that comes back in a big fashion, how quickly can it revive, or whether the larger focus will be on sale of products, sale of services. Then what does that imply to both margins as well as growth prospects for the company? That's something we'll want to really talk about. But basically, that's the real breakup, and that's why the stock has been under pressure as well. So we'll try and break this down a little bit better. For that, I have with me Rucha Somaya, who tracks IT quite closely. And she'll obviously take us through some of the metrics that we look at, and let's pull those up as well. You'll have the income statement, the balance sheet, the cash flows, as well as the return ratios that we will talk about, and how the company has fared over the last 3 to 4 years maybe, the shareholding pattern as to what's happening there, the street credentials as to what's happened to the stock price. Yes, over the last maybe 2 to 3 trading sessions, it's been under a lot of pressure, but outside of that, it's given very, very strong returns, as I did say. Then you have street coverage as well as valuations, which we will talk about. All of these key and essential to understand companies that you are investing in, and that's basically the goal that we are trying to solve for through this show. Let me welcome on board Rucha Somaya for exactly this. And Rucha, talk to us about how the income statement for this company has evolved, and what are the finer metrics with regard to Q3 in particular that is standing out, that has left the street a little bit disappointed?
Yes, Harsh. So as you rightly mentioned, most of this, the business of it comes from annuity, about 60%. So that was majorly the problem in the third quarter, because annuity revenues were not seeing growth. And even if you look at the kind of revenue CAGR that this company has provided over the last 3 years, the compounded annual growth rate at 23% might seem good, but is not healthy when you compare that with peers. EBITDA, again, a 3-year CAGR of about 15%. Again, not a good sign over here. And if we particularly talk about the Q3 numbers, as Harsh also mentioned, annuity business is the business which is, 60% of the total revenue proportion, which did not do well in the third quarter. And that is why the stock has been tanking. Even yesterday and in today's trade is down about 9% in trade. This was largely because of longer execution cycles affecting growth. Now remember that most of the IT companies also mentioned about how the execution cycles were long 2 quarters back, but they were really optimistic about how clients will make decisions after they talk about the CY25 budgets. But this clearly was not seen with Newgen, and that is why the stock has been tanking, Harsh, because of their third quarter numbers. So overall, a thumbs down in case of income statement check.
Okay. If we can quickly focus in on the balance sheet as well, and let's pull that up. We're looking at equity capital plus reserves. Currently, equity capital is 140 crore. Reserves is around 1070 odd crore. So you're looking at total equity plus reserves of roughly 1100 to around 1200-ish crore. That's the kind of number you're working with. You're also looking at borrowings, which are currently at around the 37 crore kind of mark. So very, very healthy in terms of the profitability that the management has delivered, which is reflecting on the equity of the company, and you're looking at borrowings, which is just very small in comparison to the overall equity. So a large part of the funding cost comes through equity. I also want to quickly highlight that the liabilities have gone up as the business has scaled, and there is a certain 300 odd crore of current liabilities which lie in the balance sheet as well, along with all of this. Again, looks like a healthy set because you're looking at very, very large amount of equity versus some of the other liabilities that are there on the balance sheet. And even in terms of cash and cash equivalents, if you can pull that up, looking at a healthy 330 odd crore of cash, plus you have investments of another maybe 350 odd crore. So your total cash plus investments that the company is sitting on is 700 crore, which is again a fairly large balance. And not surprising, like, right, Rucha, some of these IT companies generally sit on very large cash balances in any case. And therefore, this is not much of a surprise, but it's healthy nonetheless. So definitely a thumbs up on the balance sheet side of things.
You're right, Harsh. So generally, most of the IT companies are debt-free only, and that is why they are, called as a cash cow, or
Yes.
a lot of shareholder returns is where they are compared. But let me then get on to the kind of cash flow generation which this company has. If you look at a FY24 number, it's about 264 crore. But to give a comparison, over the last 3 years, CAGR of about 44%, which is healthy enough for an IT company like Newgen, whose large focus is on, say, annuity or product side of the business. So a thumbs up in terms of cash flow generation. But Harsh, talk to us about the kind of return ratios and then the shareholding pattern as well.
Yeah, so I mean, for an IT company, generally return ratios are fairly healthy in that sense, and therefore in relative terms, you'll see return ratios staying fairly steady at 27%, being extremely healthy compared to other segments. But also understand that IT companies, by their very nature, churn out very, very good return ratios in general. And I'll just pull out a couple of metrics here. The ROCE for a Tata Consulting is around 64%. For an Infosys, as I see it, is 40%. And therefore, when you're looking at the ROCE metric at 27% for Newgen, is there scope for improvement? Very, very likely. But as the business scales, that will likely happen. And therefore, it's a neutral on this one, largely because the growth opportunities lie. But at the same time, the ROCE number in comparison, some of the larger IT peers are definitely slightly discounted in that sense. And therefore, a 27% ROCE, very, very healthy. But nonetheless, you will likely see that number go up when growth starts to spike, which has been the case. But as the company scales, you likely see that number go up. And we'll try to understand that metric also better, Rucha. But it's a neutral on the ROCE metric.
You're right, Harsh, and even as you mentioned that as the business grows, likely that ROCE will grow. But the company itself mentioned that the business is not right now growing, especially the annuity side of the business, because of its longer execution cycle. So this can be a wait and watch for investors who are looking for a return which is actually more than the kind of return which Newgen gives. But let's also talk about the kind of shareholding over here. Free float is about 55%, 54% promoter holds, and in terms of FI and DI distribution, domestic institution holds about 9.5%. Foreign institution holding very, very less, 0.5% over here. And yeah, other than that, 34% to 35% is what we have on the shareholding pattern.
Okay. Also, one quick piece I want to highlight here. The shareholding pattern was approximately 55.2%. It's slowly and gradually tapered down to 55.1 in December and 54.3 in June of 2024. That's something you may want to keep your eye out on. Maybe some bit of that dilution due to ESOPs, but outside of that, it seems like there's also been a wee bit of dilution made by the management, but a fairly steady number in that sense, 54 to 55% in terms of their shareholding. I'll move on to Street Cred. The performance has been fairly solid when I'm looking at it over the longer term. But let's look at it in the short term and try and understand what to make of that number. The last month, of course, has been a tough month for Newgen. The stock is down 22% from the highs. The last 6 months, the stock is up despite this 22% of underperformance over the last month or so. You're seeing the stock up 21% in the last 6 months, and the one-year returns are also fairly solid at 52%. No question about the 5-year returns. It's been a 10-bagger in the last 5 years, and therefore definitely warrants a thumbs up. But the last few days, you've seen a bit of a correction, and that's where you may want to start understanding this company better to try and understand, is there an opportunity here? Anyway, Rucha, on to credentials. We've spoken about credentials, beg your pardon, but on to street coverage.
So as you rightly mentioned, 14% over the last 6 months, and this is the kind of return potential which the street is giving for the next 12 months. So not really a great picture over here, which the analysts are expecting. 4 buy calls, 2 hold and 2 sell each is what we have. But let's move on to the valuation perspective. A thumbs down over here as well because of its around 58 times its FY25 or let's say even a little more extended over the next 4 quarters valuation. If we talk about peers, OFSS at 48 times, Birla Software 25 times, might seem to be more, return reward attractive, but high valuation gives this one a thumbs down over here. But talk to us about the SWOT analysis, Harsh.
Yeah, before we go to SWOT, let's just sum up all these metrics and try and get a clear picture as to how this company is stacking up in terms of all the metrics that we've just discussed. And there you go. You've got the income statement, not exactly negative, because what you are seeing is a decent growth on the top line, but your annual revenue has seen some bit of pressure. Good to take perspective and understand as to why that is so. Balance sheet is extremely healthy. There's very low debt, and therefore the risk there is very low. Your cash flow has compounded at a healthy pace as well. Your return ratios are neutral because some of the competitors are doing better for sure. And of course, with scale, that might likely play out as well. You have shareholding, which is neutral. Management holds 50% plus, so fairly decent, holding as well. You're seeing street cred as definitely a positive. The outlook and the returns that have been given have been extremely good. Your street coverage is a neutral. Few brokers cover it, and you have just about a 14% upside in comparison to the kind of upside that the stock has already given. So it's a flattish kind of upside because it's been a 10-bagger in the last 5 years, and your valuation is definitely on the more expensive side, given that it's one of the smaller IT companies. And 5 out of 8 is the rating that we give on Newgen Software on the back of all of that. But let's quickly go across. We have Virender Jain, who's the CEO at Newgen Software, who's joining us to talk to us. Welcome, Mr. Virendra Jeet. Sorry, I beg your pardon, I got the name wrong. Virendra Jeet. Mr. Jeet, good having you here. I want to first understand from you as to what's led to the slight bit of softness on the top line in Q3 FY25. And does this at all change the outlook going ahead for you, maybe over the next 2 to 3 years? What can we expect in terms of outlook?
Good morning, and thank you for having me here. And you're absolutely right. I think we have been growing at a very healthy rate for a very long period of time, at least 9-10 quarters, consistently above 20%. And as you think, we also we want to maintain a historical growth rate of above 20%. And this is the first quarter which has been below 20% after many quarters. Having said that, if you look at 9-month numbers, we are still above over 20%. We are more close to 23% growth. And I think, as I earlier informed on what has really helped us, while the new deal win ratio has been extremely good this quarter, you will see the license revenue has grown by 70%. Our annuity models, which are typically a fallout of our implementation completion and then the ATS and the support revenues, they have slightly gone down because of so the larger implementation cycles over some of the orders which we have got over last 1.5 year. And this has really led to that the new deal momentum has not really compensated for the gap in that. We don't see this as a permanent issue. We think that these execution things should get sorted over a couple of quarters, and the normal revenue streams of annuity should start compounding again. Today, I think we are almost at the lowest of it's almost like 9% YoY growth on the annuity part. I think over next 2 quarters, we should see that gradual improvement in that. And in 3 to 4 quarters, it come back to the growth rates. Having said that, we are still looking at maintaining our growth rates and we want to compensate through new deal acquisition in terms of getting more and more deals in the market. The marketing is looking healthy for us. Our traditional markets are performing well. APAC is right now leading from front, but it's also a smaller base of revenue. And US is where we are investing and we're trying to crack that puzzle.
Mr. Jeet, just a quick follow on. What's led to the softish number and what gives you the confidence that recovery will happen on the annuity part of your business?
Yeah, so I think let me again explain. So if you look at the numbers, I think our business generally follows about new deal acquisition because all other revenue streams are downstream. And if you look at the new deal acquisition has not softened. In fact, it has accelerated. What has softened is typically once the new deal gets implemented, we have two more revenue streams kicking in, which is the support and the AMCs. Those have got delayed for a substantial amount of time due to larger implementation cycles, especially in some of the larger orders which we have taken over the last 2 years. Now, this is a phenomena which does not, because finally these executions have to resolve. They will take their time and finally the revenue streams will kick in. So there is no reason that they should not kick in. On the other side, most of the deals which we have taken over the last 2 quarters and are now taking don't have these challenges. They are shorter implementation cycles and they should start following the traditional cycle. So I would internally believe that this is a one-off, example of, couple of quarters. It is not going to last beyond that. I'm gung-ho and bullish about the business because our deal momentum continues to be good. So we keep on winning across all territories. We are investing in growth. And I think you will see that from the kind of license wins and the deals wins we also managed in this quarter. The other thing I think which is very cautious, we keep on advising everybody to look at business on an annual basis because we are still at a revenue number of roughly between 1,200 to 1,500 crores. A single deal in a quarter can change numbers drastically. Both it can be in the positive side as well as in the negative side. So I would always advise to look at this company in the numbers and annual number basis. And we have maintained that we should have always a potential to grow about 20% annually. And I don't think there's any reason why we can't continue doing that.
Okay, thanks for that, Mr. Jeet. But you talked about the longer execution cycles. Other than the shorter ones which are there in the pipeline, I want to particularly focus on the longer execution cycles. So, most of the clients, as you mentioned, are talking about how the decision is getting delayed and pushed out. So that can be because of the macroeconomic uncertainties as well, and no one is sure that will recover, right? So by the time a longer execution is still pending, revenue growth will not come back, right? So then the picture for the near term is a little bit hazy, don't you think so?
No. I think what we understand, I think it has nothing to do with execution cycle. These are only businesses which have been won and are in execution. And part of our revenue, if you understand, I'll again explain the way our business is. We end up selling our software licenses, followed with implementing those licenses. And as soon as the implementation is in process, our two important revenue streams kick in, which is the ATS, annual technical support, which is roughly around 18 to 22% of our license, and followed with additional support revenue. These two streams don't kick in unless the implementations get covered. We don't need, for implementation, we don't need new contracts or new permissions from client. We need to execute them and get the completions from that. So I don't think these are the economic scenario is linked to the past business. The economic scenarios or decision-making cycles can link to the deal acquisition velocity, which we are getting in future. In that case, right now, we are not seeing too many challenges in that, especially in the emerging markets. We don't see the challenges which we have in US and Europe. So we continue to win these markets. And we are hoping all that the US resolves itself and we are getting slightly more better momentum in the US. I hope that clarifies.
Yes, it does. It does, sir. Want to understand how margins will evolve, both on the EBITDA side as well as the PAT side. Your EBITDA margins got better as a result of everything that's transpired this quarter. Likely that they will come off as revenue starts to normalize, maybe next quarter onwards or the following quarter. So my sense is, or from whatever you've been saying, it will take a quarter or two for revenue to come back and therefore margins will come off as a result. How should you see the margin trajectory as well as the PAT margin trajectory?
I think, we are a company which always invests for growth, and so our costs are slightly front loaded. So in the beginning of the year, or many years, we have been projecting always for a higher than 20% growth. So our costs are always pegged between something between 17 to 20%. So any annual growth rate which is above 20% will keep on expanding margins. So I think for even this year, you have seen the margins have expanded. Our PAT has grown for 9 months to 40%. And for the quarter, it has been at 30%. So, so I don't think the Q4 can make significant impact on, on the margin and the PAT in such a way. Having said that, what we keep on doing is that the function of business, as we grow, the margins do expand because it's a 65% gross margin business. And between our license and ATS, 50% business has no direct costs. So they're typically what you call extremely high gross margin businesses. So with every little growth, you will have expansion of margin. But on the other hand, product companies do have to invest aggressively in sales and marketing and R&D. Today, our investments are roughly around 10% in R&D and roughly around 22% in sales and marketing. With increased growth and increased expansion, we will keep on increasing our investment in sales and marketing and R&D to make sure that we keep on capturing and maintaining a higher growth momentum. So I don't see margin challenges if the company keeps on performing at a growth of 20%. Any year, if we crash below 20%, which slightly, the less likelihood, but if case it happens, in those years, we will have flatter margins or even a decline in margin.
So you're investing, or rather you're spending on marketing as well as building your products. Yes, R&D. And therefore, this 10% and 22% or that the numbers that you gave, is that on top line that you spend annually?
Yeah, that's on the top.
Okay, understood. And do you capitalize that cost? So therefore, does it get built into your ROCE? I'm just trying to understand how return ratios will work.
Our all costs are taken in the P&L.
Understood. And therefore, your ROCE will continue to remain elevated and only get better from here as your top line grows?
Yeah. I think, see, this is a function of typically the product companies. Basically, they keep on improving on all numbers as they grow, as they become larger, because that's the function of their business. So we do hope to continue keep on improving all these numbers. But we also, unlike we have also, our purpose of building this company is to keep on making a larger company and take larger global share and our place right at the table. So we keep on investing in R&D and keep on investing in sales and marketing. And but our, in terms of a guidance that as a kind of a prudence, we do want to maintain a healthy net margin of roughly around 20% and roughly around 23% EBITDA margins. As long as we are there, we feel comfortable. Beyond that, we keep on investing on growth.
Thank you so much, Mr. Virendra. It's been great speaking with you, understanding the business as well as the Q3 numbers and the outlook going forward. But out of time on this one, honestly, from Rucha, myself, everyone who puts the show together, thanks so much for watching. And we hope you found this productive. Stay tuned to this show, KYC, as well as more on the other side. Stay tuned to NDTV Profit.